Now, US stocks are holding firm near all-time highs after a rally powered by optimism around a potential peace deal in the Middle East. Joining us now to reflect on where we are on this market story, Greg Fleming, President and CEO of Rockefeller Capital Management, a regular guest on this programme. Greg, really nice to speak to you. Thanks for joining us once again. So we're at an interesting time, actually, for markets because, as you pointed out to me in the break a moment ago, the S&P has recouped its losses from the period of the war. Incidentally, so have some of the markets over in Asia. Europe has yet to do that. It seems as if markets are trying to move past this narrative and go back to other narratives. Do you think that's wise? Is that premature, or is that about right?
Well, it's a complicated time, and I'd say a few things in response to this. Number one, coming into the year, we were coming off of 3 years of strong equity returns, over 50% over 3 years. That hasn't happened very much in history, and typically the fourth year has more challenges. You're later in the cycle, you're later in the credit cycle. So coming into the year, we knew there would be more volatility. So you add on to that, the second thing I'd say here is an oil shock, which has obvious implications for inflation, but it also has implications for demand, particularly in parts of the world. You just mentioned Asia. There are certainly economies there that are really going to struggle if this holds in there longer. But the third point I'd make, which I think is the countervailing point, particularly in the American markets, but maybe more broadly, is AI, which remains a major theme, and for good reason, because the speed with which the technology is being deployed and the breadth of companies that are now either directly or working in partnership with some of the big providers like Anthropic and OpenAI to implement the tools and begin to show productivity improvements is quite high.
Yes.
So I think, when you piece all of those things together, there's a lot of uncertainty. Nobody, in fact, really knows where it's going to go because of the interplay of the different parts of this. But it's not as clear-cut as people might have thought when the war started, that you're going to have an oil shock, markets will be down, and down for an extended period of time. That's clearly not the way the market's reacting.
And I wonder, Greg, so are you finding space then in conversations with clients to talk about AI? Are clients wanting to discuss this as a theme that they really want to get back to investing behind?
100%. Now, remember, Anna, our clients are high net worth and ultra high net worth. So we have long-term plans in place with them. They typically stick with these plans even through times like what we're dealing with now. We're not looking to make major shifts with them. Our private advisors work with them on these plans, and they stick to them. You might make pivots and adjustments based upon what happens in markets, but clients are pretty steady in our client base. But they are very focused on AI. They're very focused on AI in many ways. From an investment standpoint, there's obviously shifts there. I mean, you look at what's happened in the software industry over the last 12 or 18 months, and that was significant and rapid. What are other industries that are going to be affected by AI in a way that you need to think about investments there, from an investment standpoint, but also industries that are going to be able to create a lot more productivity. And then our clients are focused on AI and how we're implementing it at Rockefeller Capital Management. How are we going to use the tools to make our interface with them more efficient and better for the client?
OK. You mentioned there that high net worth individuals is the focus, and they make adjustments based on the news flow, but broadly they follow the plans. I mean, I wonder if for some clients, depending on their geography, whether the events in the Middle East have been a time for a big rethink about where the money is and in how many locations and in what currency and all of those associated conversations. What do those conversations look like? Well,
most of our clients are American clients, and I think for them, not major pivots, but it does highlight the need for a diversified strategy and a long-term strategy. So I think that that just reminds people that it is a volatile world, that things that people think aren't going to happen or shouldn't happen do happen. So I think that does affect investors in the United States, but, around the world, clearly. I mean, there are many companies, a lot of them in Asia, that were performing quite well, that the shock from oil prices creates an immediate issue there. So that highlights the fact that things can change quickly, and it comes back to the long-term plan and the diversification.
Yes, and I wonder how much the thinking around private credit is evolving. So in those long-term plans that those high net worth individuals have, I mean, we've seen some high net worth individuals wanting to get reduced exposure to private credit as a result of some things that have happened, and software and AI threats to software is part of that conversation, of course. How is that evolving, the private credit narrative?
Well, more broadly, alternatives in private markets is such a big slice of the investing pie. $20 trillion of assets in not just private credit, but infrastructure, private equity across the landscape. And our clients, because they're high net worth and ultra high net worth, they can withstand the illiquidity of those investments. So our clients are still broadly invested across alternatives and across private markets, including in private credit. You know, when we look at private credit, from most of the major players there, and from what we see, there isn't something fundamental and secular. Clearly, there are industries that are being impacted by AI that affect the private credit business. And one of the things that the private credit providers need to focus on is software changed quickly. Literally in 12 to 24 months, it went from an industry that everybody wanted to lend to an industry where there's dramatic change. What are the industries that AI is going to affect from here that the private credit providers need to focus on ahead of the game so that they're diversified against that possible change, which again could be quite quick. Yeah. But for our clients, we keep them invested in alternatives. They have exposure in private credit. We're careful with the different firms that we work with. We don't see something fundamental in the space. The other thing, Anna, I would say is, you know, we are later in the credit cycle, and private credit, as you know, grew out of the credit crisis, which you and I were part of, when the banks, because of regulation, pulled back, and the private credit providers really were born during that time. And, you know, those investments are into smaller companies. The returns on those funds are typically higher yield with higher defaults. Defaults have been very low over recent years. We're later in the cycle. So some of what's happening there was, again, inevitably going to happen as the cycle went on. Software reinforced that, driven by AI. There will be other industries that AI impacts that the private credit providers need to be aware of. But for us, it's still an asset class that we're comfortable with clients being exposed to with the right providers.
Okay. And so when you explain to clients, or maybe they see it for themselves, around gating and around, you know, do high net worth clients, do they see gating in private credit and private markets more broadly, and the lack of transparency that's maybe attached relatively to those kind of products, do they see that as a feature and a positive, actually, because it protects their investments from sort of panic fire sales, or do they see it as a negative to try and overcome?
I think they mostly see it for what it is, the positive to protect against fire sales. We're quite clear with our clients when they go into a fund with a potential gate that the gate's there. There's some history on this. As you know, Blackstone with BREIT had a gate several years ago, so there are a lot of clients in the wealth space that saw that gate and saw what happened from there. So I think the sophisticated clients, the high net worth and ultra high net worth, they're aware of it. They don't react, you know, immediately in a negative fashion. They watch the returns from there that the providers are providing. They watch how the firm is responding to the environment. There's not a sense of the gate goes up and there's panic. We don't see that with our clients, and I don't think you typically see that across the broader high net worth and ultra high net worth spectrum. I will say that I think broader retail, maybe mass affluent, will be more cautious on some of these you know, alternative products like private credit going forward because of all the media attention. There is no interview that anybody like me does now. Not that you know you hit a lot of topics, not just the ones that are out there, but this is a topic that everybody wants to talk to on a recurring basis.
Yes, absolutely. It is newsworthy. Greg, thank you very much.
Great to see you.
Thank you so much for joining us. Greg Fleming, President and CEO of Rockefeller Capital Management.